The most significant change to stock markets in the last 400 years, however, has been the introduction of computers, which have profoundly affected investing and trading behaviors, as well as revolutionizing the plumbing of the financial system. Things really started moving in 1971 when the National Association of Securities Dealers created an automated quote system that would facilitate OTC trading by allowing brokers to post what their buy and sell prices were for assets which weren't being traded over stock exchanges. This, of course, introduced the idea that multiple people could participate as a specialist or a market maker, and it significantly reduced the bid-ask spreads of securities that were being traded over the counter. 17 years later, to complement the quote system, they introduced the first completely digital trading platform, the NASDAQ, now known as the world's second largest stock exchange. Digital trading platforms such as the NASDAQ are now very widespread today. There are no exchanges anywhere in the world that have adopted a computerized infrastructure who have gone back to their old open outcry systems. Now, when we revolutionize the stock exchange itself and move towards a computerized stock exchange, it shouldn't be surprising to anyone that the participants of the stock exchange bring their computers as well. And so we see the beginning of program trading starting, where we have sophisticated algorithms and programs being used to execute trades rather than everything being done by individuals. By the early 2000s, it was estimated as much as 2/3 of the trading on the New York Stock Exchange was being conducted by computers who were simply trading with other computers. Now, the advent of computerization also created the possibility of a discount broker. Since orders were simply going to be channeled through software to other software, there wasn't a lot of need to be sending well-dressed, expensive open outcry agents down to the stock exchange floor and paying all the higher commissions associated with these human resources. Instead, discount brokers rethought their industry and realized that there was a whole market in simply providing access to the exchange, not necessarily providing advice, which is how brokerage services had typically been packaged over the prior century. So this revolutionized things, and we saw significant pressure beginning to emerge on the kinds of commissions that were being charged to people. Unsurprisingly, these reduction in commissions and the ability to trade using a computer changed things dramatically for retail investors. The first big bubble that we see occurring with retail investors and computers happens unsurprisingly within just half a decade of the internet being released to the public in 1995. By late 1998, we already see the beginnings of day trading phenomenon, where there are people simply staying home all day to work as traders, simply buying and selling the stocks generally of technology companies. So they had unusual amounts of access to this market, and for the most part, were investing in new unproven companies. While some of them would turn out to be the eBays and PayPals and Amazons of the future, a number of the companies which were floated during the dot-com bubble in 1998 and 1999 were complete garbage business models. For example, the venture proposed by Webvan, which would give a 24-hour-a-day, 7-day-a-week platform for people who wanted to order online groceries. A generation later, this seems perfectly normal under COVID, until you remember that in 1999, Webvan was promising to deliver your groceries in any 15-minute window of your choosing during a 24-hour period. The company invested a lot of money into computers and warehouses and went bankrupt before ever turning any kind of profit for investors. Now, of course, investors don't just move in on their own into markets where they don't understand things. It's also required that we have liars who are deceiving people into what the opportunities in the future are. And the investment analysts, in this case, were the guilty parties. These were not the kinds of promoters that we had seen in 1929 or in 1720, simply trying to lie their way into having investors buy the shares. Instead, these security analysts were attempting to attract IPO business from the people they were writing these glowing reports about. In fact, at the very top of the dot-com bubble, it was estimated that 95% of shares traded on the New York Stock Exchange were rated either a buy or a hold by investment banks at the top of the bubble. Just 5% of companies were deemed to be due for a fall right before the entire party ended. Unsurprisingly, there were a lot of lawsuits which followed from this, and we actually see a reform in the regulatory structure that investment banks operate under as a direct result of this rather significant conflict of interest, in which people both made fortunes but also lost them in the 2 years immediately after. We see again the rise of retail traders in the unusual market turbulence experienced in Chinese markets in 2015. President Xi Jinping himself had widely promoted the notion of a Chinese dream to household investors, that the promise of the future lay in investment in China A shares. What may have started off as a desire to see the gains of capitalism be widely spread through the public sector very quickly turned into millions of people opening trading accounts and pouring money into investments that they simply did not understand. Between June of 2014 and 2015, the market in Shanghai rises by 150%. In Shenzhen, the market rose by even greater amount than that. 1 week in April, right as the bubble was reaching its heights, as many as 4 million new brokerage accounts were opened in China by retail investors. By May 2015, right before the bubble burst, margin lending was as much as 4 times its historical norm. Despite these sort of telltale signs of a bubble, however, it seems that many people were caught off guard by this. So it's important to recognize that while retailers may benefit dramatically from being able to participate in industrialization, the biggest danger is that all of the people in the market will feel the same way at the same time and fail to account for the fact that prices need to be supported by earnings, not simply supported by dreams of the future or speculations about what the future might hold.